Friends, we will start with the problem section. First question: three companies A, B, C are in the same type of business and hence have the similar operating risks. However, the capital structure of each of them is different from the following are the details. Equity share capital 4 lakhs, 2 lakh 50,000, 5 lakhs. Face value is 10 rupees per share. Market value per share is 15, 20, 12. Dividend per share is 2.74, 2.88. Debentures nil 1 lakh, 2 lakh 50,000. Market value of the debentures nil 125.80. Interest rate nil 10%, 8%. Assume that the current level of dividends are generally expected to continue indefinitely and the income tax rate at 50%. You are required to compute the weighted average cost of capital of each of the company. Friends, before I get into the solution, let me remind you about the concept which we studied when we studied the theory. That is, we understood the point that there are two types of capital. One is equity capital and another is a debt capital. And a debt capital, when we look at the cost of it, we have to understand the point that it has got tax saving impacts. So, by duly considering the tax saving effect, we need to calculate the cost of a debt. Now, when we talk about the weighted average cost of capital, first you need to calculate the cost of debt and cost of equity, and also you have to calculate the proportion in which equity capital is to the total capital, debt capital is to the total capital, and this proportion you put it as a weight, and that the weight is to be multiplied with the costs, and you should make sum total of the weighted average cost of capital is the point. That is the specific procedure we learned. Now, the same procedure in the problem solution, how it comes, you just take it. First, important aspects that you are going to learn right at one place and solution at one place. First point is, we need to consider market value of the share, while computing cost of debt, cost of equity. Accordingly, market value of equity shares, company A, 4 lakhs divided by 10 into 15, 4 lakhs divided by 10 into 15, 10 is the face value, 15 is the market value. So, it makes it to 6 lakhs. Similarly, company B, 2 lakh 50,000 divided by 10 into 20, that and all makes it to 5 lakhs. Company C, 5 lakhs divided by 10 into 12. How much it is? 6 lakhs. Next, we need to consider market value of debentures. Accordingly, market value in case of company A nil, market value in case of company A nil, in case of company B 1 lakh divided by 100 into 125, 1 lakh divided by 100 into 125, that and all makes it to 1,25,000. Similarly, in case of company C 2,50,000 divided by 100 into 80, that and all makes it to 2 lakhs. First, we should be sure with this, and then what more you require is we have to prepare in a tabular manner the data presentation and then arrive at the weighted average cost of capital. So, take the table, serial number, particulars, company A, company B, company C. First, shares at market value, serial number 1, shares at market value 6 lakhs, 5 lakhs, 6 lakhs. Number 2, debentures at market value nil, 1,25,000, 2 lakhs. Then proportion of the shares, what is the proportion of the shares? There is no debentures means shares constitutes 100%. Then in case of the company B, total of the share capital and the debenture capital put together is how much, friends? So 5 lakhs divided by 6 lakhs 25,000, 80%. In case of the company C, 6 lakhs plus 2 lakhs divided is 8 lakhs, 6 lakhs divided by 8 lakhs is 75%. Then proportion of debentures, fourth is proportion of debentures. In case of company A, it is nil. In case of the company B, 1,25,000 divided by 5 lakhs is equal to 20%. In case of company C, 2 lakhs divided by 8 lakhs is equal to 25%. Next comes the point of cost of equity share. There are different methodologies of ascertaining the cost of equity, friends. One of the methods which we studied is DPS by EPS, DPS by market value of the share. DPS means dividend per share divided by market price per share into 100 will give you the, what is it, cost of equity. In the inner column you write DPS divided by MPS into 100. In case of the company A, what is it? 2.7 divided by 15 into 100. That works out to be how much? 18%. In case of the company B, 4 divided by 20 into 100. How much? 20%. In case of the company C, 2.88 divided by 12 into 100. How much? 24 percentile. Next, cost of debentures. How do you calculate the cost of debentures, friends? Debenture interest, or other way around, interest into 1 minus tax rate divided by market price. Interest into 1 minus tax rate divided by market price of the debentures. In case of company A, nil. In case of company B, 10 into 1 minus 50% divided by 125. Whole multiplied by 100. कितना? 4 percentile. In case of the company C, 8 into 1 minus 50% divided by 80 into 100. कितना? 5%. Now, how do you calculate the weighted average cost, friends? Weighted average cost of shares, right? Weighted average cost, 7th column, 7th item, weighted average cost of shares. Weight multiplied by cost. Weight means that proportion. 100% into 18% makes it to 18%. In case of company A, 100% into 18%, that is 18%. In case of the company B, 20% into 80%, कितना? 16%. In case of the company C, how much? What multiplied by what? 75% into क्या परसेंटेज है? कितना आ गए? डू इट केयरफुल्ली ब्रदर. तुम्हारा कॉस्ट ऑफ शेयर कितना है? 24% है. वो 24% के ऊपर 75% कितना? 18%. Weighted cost of debentures. Weighted cost of debentures. Nil in case of company A. In case of the company B, 4% into 20%. कितना हो गए? 0.8%. Similarly, the next issue is what? 5% into 25% makes it how much? 1.25%. Now, ninth, weighted average cost of capital. Weighted average cost of capital. Weighted average cost of capital. 18% plus 0, 18%. 16% plus 0.8, 16.8. 18% plus 1.25% is 19.25%. So, successfully we did one problem, and what is the concept based on which we did this problem? Weighted average cost of capital calculation of WACC. What is the procedure? First calculate the market value of the equity share, market value of the debentures, then cost of equity, then cost of debt, then proportion of equity to the total capital, proportion of the debt to the total capital, and that proportion multiplied by the cost of equity and that proportion multiplied by cost of debt, then sum total of those two things will give you the weighted average cost of capital is the point. Now I move to the second question. Z Limited is presently financed entirely by its equity shares. Current market value is rupees 6 lakhs. A dividend of rupees 1,20,000 has just been paid. This level of dividend is expected to be paid indefinitely. The company is thinking of investing in a new project involving an outlay of 5 lakhs now and is expected to generate net cash receipts of rupees 1,05,000 per annum indefinitely. The project would be financed by issuing 5 lakh debentures at a market interest rate of 18%. Ignore the tax considerations, calculate the value of equity shares and a gain made by the shareholders if the cost of equity rises to 21.6%. Prove that weighted average cost of capital is not affected by the gearing. So what you need to prove? Weighted average cost of capital is not undergoing a change because of your implanting the debenture capital into the concern, because whatever the benefits that arises because of the utilization of the cheaper debt capital gets completely eaten away by the increase in the expectations of the equity shareholders. This theory who said? Martgilani Miller told this. हमारा मार्टगिलानी मिलर क्या बताए? जितना बेनिफिट आपको डिवेंचर कैपिटल में से आ रहा वो सब गेट्स ईटन अवे बाय whom? By the increase in the expectation of the equity shareholder. वही पॉइंट ए प्रॉब्लम से हम we are what is it? Feeling that particular concepts. You will be able to do it provided you have studied that Martgilani Miller after going to the house, or at least you listened to the class carefully, right? But procedure wise it is the same procedure. So first what we do is like projected cash flows. Projected cash flows. What is projected cash flow from the new project, friends? 1,05,000. Less debenture interest at 18%. Less debenture interest at 18%. How much? 5 lakhs into 18%. Write down. 5 lakhs into 18%. Makes it to 90,000. Then surplus available for dividends. Surplus available for dividends 15,000. कैसा? 1,05,000 में से 90,000 डिवेंचर इंटरेस्ट दे दिए तो 15,000 फायदा बेनिफिट आएगा. देन ओरिजिनल डिविडेंड. ओरिजिनल डिविडेंड कितना पे करें आप? 1,20,000. तो टोटल डिविडेंड 1,35,000. How do you calculate the value of equity, friends? Write the formula. Value of equity is equal to dividend divided by cost of equity. Dividend divided by cost of equity. Whole multiplied by 100. That is 1,32,000 divided 1,35,000 divided by 21.6 whole multiplied by 100. 6,25,000. Original value of the shares. Original market value of the shares. 6 lakhs. Thereby gain to the shareholders. Gain to the shareholders. How much? 25,000. So the first part of your question requires what? Calculate the value of the equity shares and the gain made by the shareholders if the cost of equity rises to 21.6. अब क्या बताना मैं? Prove the weighted average cost of capital is not affected by gearing. Right. Friends, first tell me, presently your company has got any debentures? No, because this company is a company with pure equity, isn't it or not? Presently financed entirely by, what is it? Equity shares. In theory, what we studied, for a company with a pure equity stream, what is the cost of equity? That will be the weighted average cost of capital. यदि आपको डिबेंचर्स नहीं है तो कॉस्ट ऑफ इक्विटी जितना रहता उतना ही तुम्हारा वेटेड एवरेज कॉस्ट ऑफ कैपिटल भी रहता. Isn't it or not? Write a small note. For a company with a pure equity stream, for a company with pure equity stream, pure equity stream का मतलब क्या हुआ? उसमें डिबेंचर्स नहीं होता. Pure equity stream, weighted average cost of capital, weighted average cost of capital is equal to cost of equity. Accordingly, present weighted average cost of capital is, present weighted average cost of capital is cost of equity is equal to cost of equity. That is, कैसे कैलकुलेट करते कॉस्ट ऑफ इक्विटी को? डिविडेंड्स डिवाइडेड बाय मार्केट प्राइस into 100. Presently, what is the dividend, friends? 1,20,000 divided by 6 lakhs into 100. That is equal to 20%. Then, friends, in future, after raising the debentures, computation of weighted average cost of capital, computation of weighted average cost of capital. कैसे करते? Particulars, market value, particulars, market value, proportion, costs, weighted average cost of capital, cost, weighted average cost. First, in particulars, shares, debentures, shares, then debentures. Shares, what is the market value, friends? 6,25,000. What is the debentures? 5 lakhs. What is the proportion? First add the total. 6,25,000 plus 5 lakhs is equal to kitna? 11 lakhs 25,000. What is common factor? 1,25,000 is the common factor. 5 by 9, 4 by 9. Proportions are 5 by 9, 4 by 9. Cost. Shares का cost कितना है? With the increase in the debenture capital, your cost of equity came to 21.6%. And your debentures you have raised at 18%. Cost of equity is 21.6, debentures 18%. Now 5 by 9 into 21.6, weighted average cost of capital. 5 by 9 into 21.6, 12%. Similarly 4 by 9 into 18%, 4 by 9 into 18% makes it to 8%. Put together is what? 12% plus 8%? 20%. So hence proved. What is hence proved? Now also weighted average cost of capital is 20%. Earlier also weighted average cost of capital is 20%. Just how we proved, na? Got the point? Like these problems only will come in the exam. Is it a tough task? Provided you understand the procedure part of it. It's not a tough task, provided you understand the procedure part of it. There's nothing great that logic we have to apply here. Carefully we have to observe what is the requirement of the question and how to put it in a structural manner. So, third question ko dekh lo. X Limited, widely held company, is considering major expansion of its product facilities. कितना alternatives है? A, B. Share capital 50 in case of A, B is 20. 14% debentures, nil 10. Loan from a financial institution at 18% per annum. In the alternative A, we don't take any loan. In the alternative B, we take the loan. 10. Then the next issue is expected rate of return before tax is 25%. Rate of dividend of the company is not less than 20%. The company at present has got low debt. Corporate taxation is 50%. Friends, alternatives there are, it's not two alternatives, it is three alternatives. Under the third alternative, share capital is 10, 14% debentures is 15, loan from financial institutions at the rate of 18% is 25. So, which alternatives you have to choose? Which alternatives you have to choose means what? Ultimately, the question requirement is what? Or other way around, the concept requirement is what? When I started the cost of capital and capital structure theories, I started the dialogue with one point. What is it? When you have got alternatives only, decision making is required. When you got alternatives only, you require decision making. And any decision making in the finance is what? To increase the earnings of the shareholders. Under which option? Earnings of the shareholders are the market value of the share capital is more and the cost is less, that is the best option. Do you remember? Yes. Now the same concept here through problem we are doing. That's it. तो पहले लिख लो, alternatives are to be evaluated and should be ranked based on rate of return on share capital, based on rate of return on share capital. अच्छा, तो let us look at that return concept. First thing is, what is the total capital employed and what is the return? That gives you the earnings before interest and tax, operating income. तो एक टेबल बना दो, उसमें पर्टिकुलर्स एक है, कंपनी ए, कंपनी बी, कंपनी सी, सॉरी ऑप्शन ए, ऑप्शन बी, ऑप्शन सी फॉर द कंपनी एक्स, isn't it? तो पर्टिकुलर्स के लिए एक कॉलम, ऑप्शन ए के लिए एक कॉलम, ऑप्शन बी के लिए एक कॉलम, ऑप्शन सी के लिए एक कॉलम. पहले रिटर्न एट द रेट ऑफ रिटर्न at the rate of 25%. Return at the rate of 25%. Friends, small correction we are suggesting to you, that is in the option B 14% debentures के जगह पे आप जरा 10 के बगैर 20 लगा दो. क्योंकि ये तीन ऑप्शंस में 50 lakhs ही होना पूरा. वन इज प्योर इक्विटी स्ट्रीम, सेकेंड हैज गॉट equity debentures and what you call long term loans, and C also has got the same. So everything should be so return on 50 lakhs at 25%, return on 50 lakhs at 25%, कितना 12,50,000, 12,50,000, 12,50,000 less interest on debentures, less interest on debentures. Friends, as far as A is concerned, nil. As far as B is concerned, 20 into 14%. 20 into 14% is how much? 2.8. 15 into 14%. 2.1. Then interest on loan, interest on a loan. In case of alternative A, nil. Alternative B, 10 into 18%, 1.8 or 1,80,000. 25 into 18% makes it to how much? 4.5 or 4,50,000. Then profit before tax. Profit before tax 12.5, 7.90. How come 7.90? 12.5 minus 2.8 minus 1.8. 7.90 12.5 minus 2.10 minus 4.50 makes it to 5.9. Next, income tax at the rate of 50%. Income tax at the rate of 50% makes it to how much? 6.25, 3.95, 2.95. Then profit available to the equity shareholders. Profit available to the equity shareholders. कितना? 6.25, 3.95, 2.95. Then rate of return on share capital. Rate of return on share capital. 6.25 divided by 50 into 100. 12.5%. Similarly, company B, 3.95 divided by 20 into 100, 19.75. Then 2.95 divided by 10 into 100. How much it is? 29.5. What is that 50? 50 is the equity share capital. What is the 20? 20 is the equity share capital. What is the 10? 10 is the equity share capital in the option C. Isn't it or not? Are you able to get the point? So write the conclusion. From the shareholders' point of view, from the shareholders' point of view, alternative C brackets, highest should be chosen since rate of return is 29.5%. Now we move to fourth question. Read carefully the question. The Modern Chemicals Limited required 25 lakhs for new plant. This plant is expected to yield earnings before interest and taxes 5 lakhs. While deciding about the financial plan, company consider the objectives of maximizing the earnings per share. किसी का भी ऑब्जेक्टिव वही होता. What is the ultimate objective in finance management? Maximizing the earnings per share. करेंगे. पहले options बताओ. It has 3 alternatives to finance the project by raising a debt of 2.5, 2,50,000 or 10 lakhs or rupees 15 lakhs and balance in each case by issuing equity shares. पूरा कितना पैसा होना? 25 lakhs. यदि हम डेट 2.5 लिए तो इक्विटी कितना लेना पड़ता? 22.5. यदि हम डेट 10 lakhs लिए तो इक्विटी कितना लेना पड़ता? 15 lakhs. यदि हम डेट 15 lakhs लिए तो इक्विटी कितना लेना? 10 lakhs. You are halfway through. The company's share is currently selling at what price? 150. So present market value per share is 150, but is expected to decline to 125 in case funds are borrowed in excess of 10 lakhs. यदि तुम्हारा डेट 10 लाख से ज्यादा हो गए तो your market value per share will come down. Why market value per share will come down? Because as you increase the debt component in the capital structure, risk perception will go up. Increased risk perception will increase the expectation. Increased expectation in the earnings will decrease the market value of the equity shares. Is this not the theory what you have studied? Yes. Next. The funds can be borrowed at a rate of 10% up to 2,50,000, at 15% over 2,50,000 up to 10 lakhs, and at 20% over 10 lakhs. The tax rate applicable to the company is 50%. Which form of financing should the company should choose? This is what we have to do. First, what we do is, first, let us write the three options. First, particulars, option 1, option 2, option 3. Total fund requirement, either under A or B or C, totally it is how much? 25 lakhs, 25 lakhs, 25 lakhs. Less debt capital, 2,50,000, 10 lakhs, 15 lakhs. Then amount to be raised by equity, amount to be raised by issue of equity, amount to be raised by issue of equity कितना है? 22,50,000, 15 lakhs, 10 lakhs. Market price per share. In the first option it is 150, even in the second option it is 150 because debt capital is only 10 lakhs. In the option C it is 125. So, number of equity shares to be issued, number of equity shares to be issued, 22,50,000 divided by 150, 22,50,000 divided by 150 makes it to how much? 15,000. Then 15 lakhs divided by 150, 10,000. 10 lakhs divided by 125 makes it to 8,000. Good. Next, interest. How do you calculate the interest? In the first option, 2,50,000 into 10%, 25,000. In the second option, 2,50,000 into 10% plus 15% into 7,50,000. कुल मिला के कितना? How much? $1,37,500. In the option 3, 2,50,000 into 10% plus 15% into 7,50,000 plus 20% of 5 lakhs. कुल मिला के कितना आ रहा? 2,37,500. 2,37,500. Next, Statement of evaluation. Statement of evaluation of alternatives. Statement of evaluation of alternatives. Particulars. Alternative 1, alternative 2, alternative 3. Earnings before interest and tax, EBIT, 5 lakhs, 5 lakhs, 5 lakhs, less interest, 25,000, 1,37,500, 2,37,500. Then EBT, earnings before tax, 4,75,000, 3,62,500, 2,62,500. Less tax at the rate of 50%, 2,37,500, 1,81,250, 1,31,250. That is 50% of EBT. Then earnings after tax, EAT, earnings after tax, 2,37,500, 1,81,250, 1,31,250. Number of shares are number of shares 15,000, 10,000, 8,000. Those figures already we calculated. Earnings per share. 2,37,500 divided by 15,000. 2,37,500 divided by 15,000 makes it to 15.833. Similarly, 1,81,250 divided by 10,000, 18.125. 1,31,250 divided by 8,000, 16.406. So what is the decision you will write? You go to the option 2. Write the point. Decision. The earnings per share is higher. The earnings per share is higher in alternative 2. In alternative 2. That is, if the company finance the project, by raising the debt of rupees 10 lakhs and issue of equity shares of rupees 15 lakhs and issue of equity shares of rupees 15 lakhs. Therefore, company should choose this option. Is the problem comfortable or do you feel any discomfort in it? We are continuing with the simpler concepts only. Now, I move to the 5th question, friends. The following is the capital structure of Siemens Company Limited as on 31/12/1998. Equity shares 10,000 shares of rupees 100 each, 10 lakhs. 10% preference shares of rupees 100 each, 4 lakhs. 12% debentures, 6 lakhs. Total is 20 lakhs. The market price of the company's share is 110 and it is expected that a dividend of 10 per share would be declared for the year 1998. The dividend growth rate is 6%. If the company is in the 50% tax bracket, compute the weighted average cost of capital. Then assuming that in order to finance an expansion plan, company intends to borrow the funds of rupees 10 lakhs bearing 14% of interest, what will be the company's revised weighted average cost of capital? This financing decision is expected to increase the dividends from 10 to 12 per share. However, market price of the equity share is expected to decline from 110 to 105 per share. So 10 marks is the question. 10 marks आ जाता सही करे तो. Right. Take first. Computation of weighted average cost of capital. By now all of you are perfect. कैसा perfect हो गया आप? You know what is the market value of debt, market value of equity, market value of the preference shares. You calculate the cost of debt, cost of equity, cost of preference shares. First find out the proportions. Then multiply those proportions with the what you call cost. So that what you get is the weighted average cost. Sum total is weighted average cost of capital of the firm as a whole. So first take it. And whenever you calculate this cost, you are governed by what? Market price. Correct. Take market price of equity shares. Market price per equity share 110 rupees. Similarly, anything is stated regarding the market price of the preference shares? Nothing of that sort, na? Similarly, market price of the debt capital, anything separately is stated? Nothing of that sort, na? So first, what we do is cost of equity, dividend per share divided by market price per share and whole plus growth rate, whole plus growth rate. Accordingly, what is it, friends? 10 divided by 110. 10 is the 10 or 100. Dividend per share is 10. 10 divided by 110 plus 0.06. 6% means 6 divided by 100 is equal to 0.06. 10 divided by 110 plus 0.06 whole multiplied by 100. कितना आ रहा? 15.09. 15.09. Isn't it or not? 10 divided by 110 into 100 plus 0.06. कितना रहा? 15.09. Cost of preference shares. Cost of preference shares is nothing but the rate of preference dividend because it don't have any tax saving effects. Cost of preference shares 10%. Then cost of debt, KD, cost of debt. कैसे कैलकुलेट करते KD को? Interest into 1 minus tax rate divided by market price of the debt. इंटरेस्ट कितना आता? 6 lakhs के ऊपर 12% बोले तो 72,000 into 1 minus 0.5 divided by 6 lakhs into 100. 36,000 divided by 6 lakhs into 100 कितना हो रहा? 6% हो रहा. Right. Now take the table. Equity share capital first. Take the table particulars and market value, then proportion, then cost, then weighted average cost of capital. First equity share capital. How much is the equity share capital, friends? Equity share capital 10 lakhs. Now here you are calculating the market value by taking the face value only, because you don't have the information regarding the market value of the preference shares and the debentures. So all the things you take it in a one, what you call, by considering the your face values. Don't take market value. Based on face value you can calculate, based on market value you can calculate. Uniformly you have to calculate. If you are calculating by market value for the equity share, for all the things you calculate based on the market value, or other way around, all book values. कितना? 10 lakhs, 4 lakhs, 6 lakhs. And then next, friends, what is the proportions? Proportions are 0.5, then 0.2, 0.3, isn't it or not? Next, costs 15.09, $10.6, multiply it, 0.5 into 15.09, 7.5. Then next is 4%. Then next is 0.3 into 6%. Makes it to how much? 0.018. 0.3 into 6% is how much? 0.018. Put together is what? Fast. Make it fast. 7.545 plus 4 plus 0.018. 11.345.